What if I told you that in just a matter of weeks, millions of Americans relying on Social Security benefits could see a significant change that might transform their financial reality before the year ends? What if this change has been quietly approved, carefully calculated, and is now ready to roll out in December 2025, affecting the very lifeline that keeps food on your table and a roof over your head? A small request: please subscribe to our channel for support. It's completely free. Right now, across America, over 15 million people depend on SSI and SSDI payments to survive. These aren't luxury checks. These aren't bonuses or extra spending money. For most recipients, these payments represent the difference between having electricity or sitting in the dark, between affording medication or suffering in pain, between eating 3 meals a day or rationing food to make it through the week. The government knows this. The Social Security Administration understands the critical nature of these payments. And that's exactly why what's happening in December 2025 is so monumentally important. This announcement carries weight, it carries hope, and for many struggling families, it might just carry the financial relief they've been desperately praying for. But here's what makes this situation even more urgent. Not everyone knows about these changes yet. The information is out there, buried in government documents, hidden in official notices that most people don't have time to read or understand. The bureaucratic language is confusing, the details are scattered across multiple sources, and honestly, the system isn't designed to make this easy for you to figure out on your own. That's where the problem lies, and that's exactly why you're here right now, reading these words, because someone needs to cut through all the red tape and confusion and tell you straight up what's happening, who qualifies, how much money we're talking about, and most importantly, what you need to do to make absolutely certain you receive every single penny you're entitled to. A small request: please subscribe to our channel for support. It's completely free. So let me be crystal clear about something right from the start. The changes coming in December 2025 are not automatic for everyone. Yes, some people will see adjustments without lifting a finger, but others, particularly those in specific situations or those who fall into certain categories, might need to take action. They might need to verify information, update their records, or confirm their eligibility. And if they don't do these things, if they sit back assuming everything will just work itself out, they could be leaving money on the table. Real money. Money that could pay for groceries, cover utility bills, help with rent, or provide that small cushion that makes life just a little bit more bearable. This is why paying attention right now, this very moment, matters more than you might realize. Let's talk about what SSI and SSDI actually are, because even though millions receive these benefits, there's still widespread confusion about the difference between them, who qualifies for what, and why the December 2025 changes affect these programs in specific ways. Supplemental Security Income, commonly called SSI, is a needs-based program designed to help people with limited income and resources who are aged 65 or older, blind, or disabled. This program is specifically targeted at individuals who might not have worked enough to qualify for traditional Social Security retirement benefits or who don't have sufficient work credits for disability insurance. SSI provides monthly cash assistance to help cover basic necessities like food, clothing, and shelter. The federal government funds this program, though some states add supplemental payments on top of the federal benefit amount. The key thing to understand about SSI is that it's means-tested, which means your income and assets are carefully evaluated to determine eligibility and payment amounts. A small request: please subscribe to our channel for support. It's completely free. Social Security Disability Insurance, or SSDI, operates differently. This program is for people who have worked and paid Social Security taxes, but who can no longer work due to a severe disability that's expected to last at least 1 year or result in death. SSDI is not needs-based in the same way SSI is. You don't have to be poor to qualify for SSDI. Instead, qualification depends on your work history and the number of work credits you've accumulated through years of employment. The amount you receive in SSDI benefits is based on your lifetime average earnings covered by Social Security, which means someone who earned more during their working years will typically receive higher SSDI payments than someone who earned less or worked fewer years. Some people actually receive both SSI and SSDI, which is called concurrent benefits, and this happens when someone qualifies for SSDI but their payment amount is low enough that they also qualify for SSI supplementation. Understanding this distinction is absolutely crucial when we talk about the December 2025 changes because these two programs, while both administered by the Social Security Administration, follow different rules, different payment schedules, and different adjustment mechanisms. The changes coming in December affect both programs, but they affect them in different ways, and depending on which program you receive benefits from, or if you receive both, your experience of these changes will vary. This is part of what makes this whole situation so complex and why so many people feel overwhelmed trying to figure out what applies to them personally. A small request, please subscribe to our channel for support. It's completely free. Now, let me address the elephant in the room, the question that's probably burning in your mind right now. What exactly are these big changes happening in December 2025? Why is this month so significant? What makes this different from any other month in any other year? The answer involves multiple factors converging at once, creating a perfect storm of adjustments, increases, and modifications that will impact benefit amounts, eligibility criteria, and payment timing. The Social Security Administration has announced that December 2025 will see the implementation of the Annual Cost of Living Adjustment, commonly known as COLA, which is designed to help benefits keep pace with inflation and rising living costs. But this isn't just any COLA increase. This is happening at a time when other policy changes, technical adjustments, and administrative updates are also taking effect, which means the cumulative impact on recipients could be more substantial than people expect. The cost of living adjustment is recalculated every year based on the Consumer Price Index for urban wage earners and clerical workers, a mouthful of a title that basically refers to a government measure of how much prices are rising for everyday goods and services. When the cost of groceries goes up, when gas prices increase, when rent climbs higher, when healthcare expenses skyrocket, the government tracks these changes through the CPIW index. Then, based on these measurements, they calculate a percentage increase to apply to Social Security benefits to help recipients maintain their purchasing power. Without these annual adjustments, your monthly check would essentially be worth less and less each year as inflation eroded its value, making it harder and harder to afford the same basic necessities. A small request, please subscribe to our channel for support. It's completely free. For December 2025, the COLA percentage has been calculated and announced, and while I'll get into the specific numbers shortly, what's important to understand first is how this adjustment gets applied and when you'll actually see it reflected in your bank account. Here's where timing gets interesting and where confusion often happens. The COLA increase for any given year is actually announced in October of the previous year, but the increased payments don't begin until January of the following year. However, because of how SSI payment schedules work, SSI recipients actually receive their January payment on the last business day of December. This is where December 2025 becomes so significant for SSI recipients. They'll receive their increased benefit amount on December 31st, 2025, which is technically their January 2026 payment arriving early. SSDI recipients, on the other hand, typically receive their payments on a schedule based on their birth date, which means they'll see their increased amount in their regular January 2026 payment, which arrives in January itself. Are you starting to see why this gets so confusing? Are you starting to understand why so many people miss critical details about when money is coming and how much to expect? The Social Security system, despite being incredibly important and affecting tens of millions of Americans, operates with layers of complexity that seem almost designed to confuse people. Payment dates vary depending on which program you're in, when your birthday is, whether your claim started before or after a certain date, and various other factors that most people have never even heard of. This is why breaking everything down, making it crystal clear, and walking through each detail step by step is so essential. Let's talk numbers, because ultimately, that's what matters most to people struggling to make ends meet. What is the actual COLA increase for 2025 going into 2026? How much more money will you actually see in your check? The Social Security Administration has announced that the COLA for 2026 is 2.5%. Now, I know what you might be thinking. 2.5% doesn't sound like much. When you're struggling to pay bills and afford groceries, a percentage point increase might seem almost insulting. But let's put this into real dollar terms and see what it actually means for different recipients at different benefit levels, because depending on your current payment amount, this increase could add up to more than you initially think. A small request, please subscribe to our channel for support. It's completely free. For SSI recipients, the maximum federal benefit amount in 2025 for an individual is $943 per month. With the 2.5% COLA increase, that maximum federal benefit will rise to approximately $967 per month starting in January 2026. That's an increase of about $24 per month, which translates to roughly $288 more over the course of a full year. For an eligible couple receiving SSI, the maximum federal benefit in 2025 is $1,415 per month, and with the increase, that will rise to approximately $1,450 per month, an increase of about $35 monthly or $420 annually. Now, remember, some states provide supplemental payments on top of these federal amounts, and those state supplements may also increase, though that varies by state and depends on each state's individual policies and budget situations. For SSDI recipients, the calculation works a bit differently because SSDI benefits are based on your individual earnings history rather than a flat maximum amount. The average SSDI benefit in 2025 is approximately $1,537 per month. With a 2.5% increase, that average would rise to roughly $1,575 per month, an increase of about $38 monthly or $456 annually. However, and this is important, SSDI payments vary widely from recipient to recipient. Some people receive significantly less than the average, while others receive considerably more, up to the maximum benefit amount of $3,822 per month in 2025. For someone at that maximum level, the 2.5% increase would add approximately $96 per month, which comes out to over $1,150 more per year. A small request, please subscribe to our channel for support. It's completely free. I know some of you are doing mental math right now, calculating what 2.5% of your current benefit would be, trying to figure out exactly how much more you'll receive. That's good. That's exactly what you should be doing. But here's something else you need to factor into your calculations. If you're one of the millions of Medicare beneficiaries who have their Medicare Part B premiums automatically deducted from your Social Security payment, there's another piece of news that directly affects your net increase. Medicare Part B premiums are also adjusted annually, and for 2026, the standard Medicare Part B premium is set at $185 per month, which is an increase of about $9.80 from the 2025 premium of $175.20 per month. This means that for people who have Medicare premiums deducted from their Social Security checks, the net increase they'll see will be the COLA increase minus the Medicare premium increase. Let's do some quick math to illustrate this. If you're an SSDI recipient receiving the average benefit of $1,537 per month in 2025, and you have Medicare Part B premiums deducted, your net payment after the Medicare deduction would be approximately $1,362. With the COLA increase raising your gross benefit to roughly $1,575 and the new Medicare premium being $185, your net payment would be approximately $1,390. That's an actual increase in your pocket of about $28 per month, not the $38 gross increase. For people living on tight budgets, understanding this difference between gross and net increase is critical for planning purposes. A small request, please subscribe to our channel for support. It's completely free. But here's where things get even more interesting. And this is information that doesn't get talked about nearly enough in mainstream coverage of Social Security changes. Beyond the standard COLA adjustment, there are other modifications taking place in December 2025 and January 2026 that could affect your benefits, your eligibility, or your circumstances in ways that go beyond a simple percentage increase. The Social Security Administration periodically updates various earnings thresholds, income limits, asset limits, and other program parameters that determine eligibility and benefit amounts. For 2026, several of these key thresholds are changing, and depending on your situation, these changes could be even more significant than the COLA itself. Let's start with the SSI program. where resource limits have remained unchanged for decades, causing significant frustration among advocates who argue these outdated limits trap people in poverty. Currently, to qualify for SSI, individuals must have countable resources of no more than $2,000, and couples must have countable resources of no more than $3,000. These limits have not changed since 1989, which means they haven't kept pace with inflation or the realities of modern living costs. However, there have been growing calls for Congress to raise these limits, and some proposed legislation working its way through the system could potentially increase these thresholds. While nothing has been finalized yet for implementation in December 2025, this is an area where recipients need to stay informed because any change to resource limits could affect eligibility for hundreds of thousands of people who currently hover right at the threshold or who have been denied benefits due to slightly exceeding these limits. A small request: please subscribe to our channel for support. It's completely free. For SSDI, one of the most important thresholds that changes annually is the substantial gainful activity amount, commonly called SGA. This is the earnings level that determines whether someone's work activity is considered substantial enough to potentially disqualify them from disability benefits. For 2026, the SGA amount for non-blind individuals is set at $1,660 per month, an increase from the 2025 level of $1,620 per month. For blind individuals, the SGA level is higher, set at $2,790 per month for 2026, up from $2,700 in 2025. Why does this matter? Because if you're receiving SSDI and you're attempting to work or engage in some form of employment, understanding these thresholds is absolutely critical. Earning above the SGA level can trigger a review of your disability status and could potentially result in your benefits being terminated if the Social Security Administration determines you're engaging in substantial gainful activity. However, and this is something many people don't realize, the Social Security Administration has work incentive programs designed to help disability beneficiaries transition back to work without immediately losing all their benefits. The trial work period allows SSDI recipients to test their ability to work for at least 9 months without affecting their benefits, regardless of how much they earn during those months. In 2026, any month in which you earn more than $1,050 counts as a trial work month. After you've used your 9 trial work months within a rolling 60-month period, you enter what's called the extended period of eligibility, during which you can still receive benefits for any month your earnings fall below the SGA level. These work incentive programs are incredibly valuable for people who want to try working again but are terrified of losing their benefits and then finding themselves unable to continue working, with no income and having to reapply for disability from scratch. A small request: please subscribe to our channel for support. It's completely free. Now, let's talk about something that causes enormous confusion and anxiety for millions of recipients: the relationship between SSI, SSDI, and other forms of income. Many people receiving disability benefits don't realize that certain types of income can affect their payment amounts, while other types of income don't count at all. For SSI recipients, this is especially complex because SSI is needs-based, so your payment amount can go up or down based on your other income and living arrangements. The Social Security Administration has detailed rules about what counts as income and what doesn't, and understanding these rules can mean the difference between receiving your full benefit or seeing your payment reduced. Earned income, meaning wages from employment or self-employment, counts toward the income limits, but SSI has exclusions that mean not all of your earned income reduces your benefit dollar for dollar. The first $65 of earned income each month, plus half of any earned income above that amount, is excluded. This means if you earn $200 in a month from part-time work, the SSI administration would exclude the first $65, leaving $135. Then they'd exclude half of that remaining amount, meaning only $67.50 would count as income that could reduce your SSI payment. Unearned income, such as other Social Security benefits, pensions, or unemployment compensation, is treated differently. The first $20 of unearned income each month is excluded, but any amount above that counts fully and reduces your SSI payment dollar for dollar. Living arrangements also impact SSI payments in ways that surprise many recipients. If you live in someone else's household and receive free food and shelter, your SSI payment can be reduced by as much as one-third of the federal benefit rate, which is called in-kind support and maintenance. If you live in a nursing home or other medical facility where Medicaid pays for more than half the cost of your care, your SSI payment is typically reduced to a small personal needs allowance, currently $30 per month in most states. These rules can seem harsh, especially for vulnerable people who are trying to survive on very limited resources, but understanding how they work is essential for planning and avoiding unexpected payment reductions. A small request: please subscribe to our channel for support. It's completely free. For SSDI recipients, the situation is somewhat simpler in terms of income because SSDI isn't needs-based. You can have other income, investments, or assets without affecting your SSDI payment amount, at least not directly. However, there's a critical consideration that SSDI recipients need to be aware of: the taxation of Social Security disability benefits. Many people are shocked to discover that their disability benefits might be subject to federal income tax, and this comes as an unwelcome surprise when they file their tax returns and owe money they weren't expecting to owe. Whether your SSDI benefits are taxable depends on your combined income, which is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. If your combined income exceeds certain thresholds, up to 50% or even 85% of your benefits could be subject to federal income tax. For single filers, if your combined income is between $25,000 and $34,000, up to 50% of your benefits may be taxable. If your combined income exceeds $34,000, up to 85% of your benefits may be taxable. For married couples filing jointly, these thresholds are higher but still catch many people by surprise. If your combined income is between $32,000 and $44,000, up to 50% of benefits may be taxable, and if it exceeds $44,000, up to 85% may be taxable. These thresholds haven't been adjusted for inflation since they were established decades ago, which means more and more beneficiaries find themselves owing taxes on their disability benefits each year, even though their purchasing power hasn't actually increased. A small request: please subscribe to our channel for support. It's completely free. State taxation of Social Security benefits varies widely, with some states fully exempting these benefits from state income tax, while others tax them to varying degrees. If you live in Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, Rhode Island, Utah, Vermont, or West Virginia, you need to be aware of your state's specific rules regarding Social Security benefit taxation. Some of these states have provisions that exempt benefits for recipients below certain income levels, while others tax benefits according to the same formulas used by the federal government. Understanding your state's approach to taxing Social Security benefits is important for overall financial planning and avoiding tax surprises. Something that deserves special attention is how the December 2025 changes affect specific categories of vulnerable beneficiaries. Let's start with children receiving SSI. Yes, children can qualify for SSI if they have a severe disability and if their family's income and resources fall below certain limits. The family's income is subject to a process called deeming, where a portion of the parent's income is counted as available to the child when determining SSI eligibility and payment amount. When SSI benefits increase due to COLA in January 2026, children receiving SSI will also see their benefits increase, subject to how deeming calculations affect their particular situation. Parents serving as representative payees for children with disabilities need to understand that these funds must be used for the child's needs and that they're accountable for how every dollar is spent. A small request: please subscribe to our channel for support. It's completely free. Another vulnerable group is elderly SSI recipients who don't have enough work history to qualify for regular Social Security retirement benefits. These individuals, often people who spent their lives in unpaid caregiving roles, in jobs not covered by Social Security, or who immigrated to the United States later in life, rely entirely on SSI for their survival in old age. The December 2025 and January 2026 COLA increase represents one of the few times their income increases, and even a small increase can make a meaningful difference when you're living on $943 per month. These elderly SSI recipients often face additional challenges, including language barriers, limited understanding of the system, and social isolation that makes it harder for them.